Is it true that Canada's economy has stagnated between 2015 and 2024? And if so, why is that the case? I'm looking forward to making today's video because we'll be covering a wide variety of topics, both on the microeconomic and macroeconomic scale. Microeconomics deals with the economic behavior of individuals and households, whereas macroeconomics deals with a broader view, that of national and international economies. The advantage of looking at a wide variety of topics is you could see how they're interrelated. So we'll be looking at the labor productivity of Canadians and comparing it to other countries, as well as across time. So let's get started on today's topic. Let's start with gross domestic product per capita, or GDP per capita, which is a broad measure of economic growth. It looks at the value of output per person, which is an indirect indicator of per capita income. In other words, you take into account all the economic activity of a country and divide it by the number of people in that country to measure productivity. With this first table, you'll see that the text is in French, but the title says Canada's economy has remained practically stable for 10 years. The period covered is from 2014 to 2024, which is pretty close to what we're aiming for. And Canada ranks 15th out of 15 countries with a GDP per capita growth of 0.5%, and that number being at around 55,000 US dollars. In seventh place, we have Switzerland, which showed considerably more growth at around 9% and a GDP per capita of 84,000 per year. At the highest level, we have the United States, which grew by 20.7% in a decade and has a higher GDP per capita. I'd like to point out that this table was made adjusted to purchasing power parity, which measures prices at different locations. So it's essentially adjusted to compare better. That's why the numbers will be slightly different than the next table that I'm going to move on to right now. And this compares Canada to 30 other OECD countries, which is an organization that looks at the economic cooperation of countries that get along, so to speak. You'll notice that Canada is pretty far down the list. There's one obvious outlier. The reason why Ireland is so high here, by the way, is that they have very low corporate taxes. So companies like Apple will move their headquarters over to Ireland so they could pay less taxes, and that has changed their GDP per capita in a very big way. However, we're looking at Canada's GDP per capita, and one thing to note here is that Canada's GDP per capita declined from 80.4% of what the US's was to 72.3% in 2002. So in other words, compared to the US's GDP per capita, Canada's fell by around 8% from 2012 to 2022. On top of that, according to this estimate, the quote is, looking forward to 2060, Canada's projected average annual growth rate of GDP per capita, 0.78%, is the lowest amongst 30 OECD countries. In other words, Canada is projected to fall to 30th place on this list. And finally, we'll look at one last chart, which shows the outlier, Ireland, as well as Canada and the United States, to put into perspective what actually happened in 2010 and 2020 and what is projected to happen by 2030. You'll see that the United States shows very stable growth and Ireland crazy growth, but Canada's economy in terms of GDP per capita is barely growing. And it's about time to explore why that is the case and why Canada has been focusing too much on unproductive assets. When I say unproductive asset, you may be able to guess what I'm thinking of. And yes, it is real estate/housing. I think it's important to look at it on both a microeconomic and macroeconomic scale, because I don't know if Canadians understand the scope of the problem and the fact that it exists on multiple levels. So if we look at how people spend monthly on rent/income, there are different ratios that people throw out. So according to the Canada Mortgage and Housing Corporation, CMHC, your housing costs shouldn't be more than 32% of your gross income. Housing costs include mortgage principal and interest, taxes, heating expenses, and half of your condo fees. Just to provide another source, Investopedia uses the common 28 to 36 rule, where 28% of your gross yearly income should go towards a mortgage and other expenses, or 36% should be the maximum to all debts, including a mortgage. When I was growing up, I always heard that it was 30% of the mortgage, but let's look at what's realistic given today's market. And we'll start off with the first chart, which clearly shows a very big difference in only 9 years. I picked the same timestamps as in the last video, so 2015, 2019, and 2024, and I have the exact percentages here. In 2015, Canadians already spent, on average, 37.9% on those costs. By 2019, it had risen to 53.3%, and somehow in 2024, it was 102.7%. So you may be asking yourself, how is this even possible? How are people able to spend so much money on housing when it's more than their gross income? The truth is that there are many possible explanations for this. People could be dipping into their savings, or more likely having that money be sourced from somewhere else. There's been a lot of studies shown that kids today, when I say kids, I mean new homeowners, are needing to rely on their parents to make these payments. And there's also the fact that there are a lot of foreign buyers that buy property in Canada, if only to put their money in a safer location, because they may be coming from countries where their money is at risk. And yes, I am talking about China for the most part, because there are many Chinese citizens that have bought real estate in Canada as a way to get it out of the control from the Chinese government, to be honest. So the Toronto and Vancouver condo markets, for example, have been largely skewed due to foreign investments, and there are pros and cons of that. But one of the realities is that it may increase prices in such a way that the typical Canadian could not be afford to buy things. And to put that into perspective, I also added another chart here, which is the price to income ratio in Canada. It's a pretty simple principle. So you compare the gross income during a year, and then you try to see how many years it takes at that typical income to buy a house. So, as an example, if you make $100,000 a year and a home costs $500,000, that ratio is five, because it takes 5 years of work at a gross pay. So, this is not taxes and all deductions, to pay for this home. In 2015, that ratio was exactly 5.5. So you have to work 5.5 years to buy a house. By 2019, it was already 7.7. And by 2024, it had almost doubled because it was already at 11. So you'll see here that a price to income ratio above 3 is generally considered to indicate that a housing market is becoming less affordable for the average household. So, according to that, even in 2015, the average home was unaffordable for most Canadians. And to put, I have a true story. So, I was at an alumni event for the University of Ottawa, and there was a panel of guests, and they were talking about housing in Ottawa and Canada as well. One of the people on that panel was a real estate developer, and he was talking about his experiences buying homes as a university student in the 80s. And I think he was a little bit out of the loop. And to be fair, I was maybe a little bit rude because he said that, well, it's pretty much the same thing today. The specific numbers that he used is that he bought a home for around $85,000, I believe, in the 80s. And on average, he made per year around 25,000. And he said, well, it's about equivalent today. But if we look at the ratio and what's recommended, um, a ratio of 3 with a $25,000 salary would be a home that costs 75,000. So he wasn't far off from this ratio. But the reality is, in today's economy, that ratio is 11, which is almost like 3 times the ratio of what he had before. So it isn't true that it's the same situation in the 1980s that it is now. I understand that minimum wage was a lot lower and the average salary was a lot lower, but it's important to keep in mind the ratios as well as the taxes you have to pay, because the more you pay in taxes, the higher percentage you pay as well. Let's not go into all the details and then look at this affordability index. The reason he called on me, by the way, is when he said that, I kind of laughed out loud and he like kind of pressed me on it. But I know the numbers like somewhat well. And like the average cost of the home at that time was about 710,000. And with an average salary of, let's say, 65,000, it's not even close. That ratio is almost exactly 11. But I think that's what I told him in front of a crowd of 300 people. Um, but we'll look at the next thing here. The affordability index in Canada, this is simply a reverse of the last chart. So we're not going to spend too much time on that. But essentially, higher values here indicates a better affordability. And the exact numbers are 2.6, 1.9, and then 1. And finally, here's the last table that discusses the 3 elements I just mentioned. Before doing the research, I knew that real estate was a problem in Canada, but I didn't understand the full extent of it. So, the reason why real estate is a problem is that it takes money away from productive assets like stocks and bonds. When you buy stock into a company, that means that you're a part owner, even if it's just a very small percentage. When you invest into a company, they can use that money to create more goods that would, in theory, lower the prices of them, offer more services that would do the same, invest in new technologies that could make manufacturing more efficient or discover new innovative methods to offer services, or in fact, invest in people and train them in new ways to offer what they offer. However, when you invest in real estate, there's nothing positive that's contributed to society. There's no innovation needed, and housing is a necessity that doesn't offer anything good to the neighbors that you have. So, the Globe and Mail wrote a great article in September 2022, and it was called Our Other Real Estate Problem: People Have Too Much Wealth Tied Up in Houses. The first problem, of course, is being the prices of real estate. So the second one would be the fact that Canadians have too much of a percentage invested into it. So at that point in time, 77% of all Canadian investments were in real estate. There were also differences between generations, with seniors having a low of 68% of their investments in real estate, 71% for baby boomers, and a high of 89% for young adults of Gen Z. In other words, the youngest generation, the ones that own the least assets or the smallest assets, have around 90% of their investments in their homes. This is based on a philosophy that has long existed in Canada, with the dream of home ownership being that you should just get into the market and watch your equity grow. However, it's not true that home prices will always go up. The US saw this with the Great Recession in 2008, 2009, and Canada saw it to a lesser extent. So home prices dropped by 30, 40, 50% in the US, and Canada only dropped by 5 or 10%. it's worth noting that in this article, it said, think of this period, the pandemic, as a freakish boom generated by circumstances that won't likely be repeated in your lifetime. We are not in a waiting period just ahead of a new housing gold rush. Interest rates today are too high for that. This was in 2002, remember? And unlikely to come down much in the next year. Without a vicious recession or a catastrophe like the pandemic, we won't see rates at the 2020-2021 level again. This is when they were at historic lows, as a reminder. So home prices peaked at $816,000 in February of 2022, which was a 20% jump over the same month in 2021. And they said that already by July, the average resale price had fallen by almost 23%. So there was a lot of variability in Canada, and we did actually see home prices drop in 2022 already. I won't talk too much about 2025, but there's been already some variability. And the main point that's mentioned in the article is that it's better to diversify your personal portfolio. So the guidelines for financial planners say that if you hold Canadian stocks for 10 years or more, you should expect an average annual total return of around 6.3% before fees. This is not only applicable to individuals or households. It's unproductive for a country to have so much invested in real estate. And the fact of the matter is that politicians from all sides of the political spectrum are very invested in maintaining the high value of home prices. But the reality is that shouldn't be a priority of the government. It shouldn't be the only priority, we'll say. And we'll get into why in this next section here. There was an article written by Better Dwelling in June 2021. And this one talked about how people make money, not only what percentage of their portfolio they have invested in real estate, but where does the profit come from in their portfolio. So in the spring of 2021, 3/4 of the gains in wealth came from real estate, which is much higher than normal. So real estate represents a very high share of gains for household wealth in Canada. In the first quarter of 2021, it was 77%. And it's not always like this way. It's the first time it was so high since 2018. Now, the article made a great point, which I was alluding to. Non-productive assets have a very different goal when stimulating the economy. Most of it is through a wealth effect, which is when people spend because they feel rich. So when your home increases in value, let's say you own 100% of it, you may feel like you have more money in your back pocket. But the reality is you'll only see the benefits of that if you sell your home or get a reverse mortgage or a HELOC, essentially meaning you have to sell your house to see any liquid money in your pocket. So the question asked here is whether this offsets the amount of spending lost by young adults is the question. So in order for the next few generations to purchase a home, they need to save a lot more. This is going to mean that they're going to spend less. And if the homeowners that have increased their homes in value spend more due to this wealth effect, well, then it's going to be a drag on the economy because ultimately it's hard to compensate for that loss of spending by these younger generations. And we'll move on to the next topic as we explore what happens next.
Infrastructure spending that actually matters to Canadians is not there. This is all about holding the course so they can look good in the next election.
So in this economic climate, how committed to a balanced budget would you be right now? Would it worry you to go into deficit in this current climate to, as you say, put more people to work?
The commitment needs to be a commitment to grow the economy, and the budget will balance itself.
Here's what actually happened with the budget over the next few years. You'll see that there's a slight deficit in 2015, 2016, but that does seem to be the exception. Obviously, there's a huge outlier here, which is the peak of the pandemic, And we're going to put this aside for now because it deserves its own discussion. So here's the projected Canadian federal debt, 2015 to 2020. And you'll notice that there's a slight surplus in the first year and modest deficits between 3 billion and 5 billion over the next 4 years. As a reminder, a deficit or a surplus is something that looks at the economy over 1 year, and the debt is the accumulation of all these deficits. So here we have the actual Canadian federal debt during that period, and there was not a surplus in sight. And in fact, a lot of these deficits were quite big. I have the exact numbers here. So it was about 2.8 billion in the first year, and then 19 billion, 19 billion, 14 billion, and then 40 billion in 2019, 2020. So if you look at this chart here, you have the projections versus reality, and there's a stark contrast between the two. This wasn't only limited to before the pandemic. So even if we just look at the 2023-2024 financial year, it was promised that we wouldn't have a deficit of more than $40 billion. In reality, it was $62 billion. So that's over 50% what was projected. And it was missing one of the three key fiscal objectives that Finance Minister Chrystia Freeland had set to achieve. So the government aims to only maintain the debt to GDP targets, which we'll talk about shortly. The finance minister famously resigned in a very vocal way on the day the budget was supposed to be announced. And the GDP growth for next year is likely to be only 1.7%, down from 1.9%. The reason why I'm bringing up the budget, debts, and deficits is the same reason that Pedro Antunes, chief economist of the Conference Board of Canada, mentioned, which is there's not really any fiscal room for them to maneuver at all, considering that there are a lot of risks in the economy coming into 2025. If you'll remember, Trump had talked a lot about tariffs in 2024 as he was elected president. And unfortunately, if you're in a situation where you don't have a lot of room to maneuver because you're already way over budget and the deficits have been accumulating over the years, that means you have less leverage to negotiate later on. So we're going to discuss this in a little bit more detail right now. So I'm now going to show you a chart of the federal debt or accumulated deficit from 1999 to 2024. So this is debt as a percentage of GDP. You'll notice that there was a big spike in 2020, as you may expect, but it doesn't seem that we're on a downward trend necessarily. So here's a quote. The federal debt stood at 42.1% of GDP in 2023-2024, up from 41.1% in 2022-2023. The government is committed to reducing the federal debt to GDP ratio over the medium term as its key fiscal anchor. And this is from an annual financial report in 2024. However, the reality is the last time that Canada had a debt to GDP ratio so high, so I mean the one in 2024, you have to go back to 2003, which was a ratio of 42.3%. The reason why the debt to GDP ratio is considered an important measure is that as a country, you have a lot of assets and you could rely upon them if you owe debts to someone. However, you don't want to be so leveraged that you have to submit to the will of other countries. So if you look at the United States, for example, they are so indebted to China that they can at one point, if China really wants to exert pressure on the United States, they could ask for their loans to be paid back and to a certain extent cripple their economy. So you don't want to be vulnerable to other countries. And when you have a very high debt to GDP ratio, you're putting yourself in that position. One other factor to consider is that Canada's GDP overall has been rising. So this is not the GDP per capita, because as Canada's population has been going up, especially over the past 3 years, the GDP goes up as well. For every new person in Canada, there is some increase in gross domestic product. So that can be a good thing, it can be a bad thing, but the reality is Canada is committed to lowering its immigration levels. So that means that its GDP relatively will be going down as well, but the debt will remain the same. So there's only two factors here. And if your GDP goes down, obviously this ratio is going to be going up, and that's a bad thing. So this is one thing to consider. Immigration levels is obviously a big topic of discussion in Canada, and it will absolutely affect GDP. We'll have to see to what extent as well. In conclusion, this video points out some of the flaws in Canada's economy that have impacted Canadians from 2015 to 2024. The explosion of housing prices, the very high percentage of wealth tied to real estate, and the reduction in disposable income are serious liabilities that should be carefully considered. Because Canada's economy has flatlined in terms of GDP per capita, both in historical terms and compared to other countries, most Canadians had less buying power and were poorer in 2024 compared to 2015. What's more, the continuous increase in Canadian debt has limited Canada's ability to absorb fiscal shocks such as the US tariffs in 2025. That's it for part 2 of Canada's economy under Trudeau, and remember to like and subscribe. It helps a lot.